The broadcast is now starting. All attendees are in listen-only mode.
Good evening, folks. As you enter the session, this is Ken Cavullo from the Mid-Michigan chapter, joined by my good friend Mark Robertson. This is Turnout Tuesday, and tonight we're going to be dealing with What's It All About Alpha. That gave me a good chuckle when I first read it, and I hope you get a really good chuckle from it as well. We'll start in about 5 minutes. Now's a great time for you to check your sound equipment if you think you might want to communicate with us out loud. I have allowed you to raise your hand, and all I ask is that you look at the raise hand icon right now. And right now it's down. It's a strange looking icon, I know, and when it's down, it doesn't look like it's down, but it's down right now. If you want to raise your hand, you just have to press it once, and I'll get a signal, and then I'll try to unmute you. We do have a text box. It's called the questions box, where you can type in a question, send it to Mark or myself, and I'll be monitoring that during the evening as well. And we guarantee that we'll try to answer all of the questions that were asked before we leave the air. We might stop about an hour into the program to close the program down, because this particular program is aimed to be 60 to 70 minutes. But once we close the program down, if we still have questions, we will try to answer them. You're still filing into the room, so welcome from the Mid-Michigan chapter. Welcome to Turnout Tuesday. And if you have questions or comments right now, we still have about 4 minutes where we can chat. So I'm watching. If anybody has anything to say, type it, raise your hand, and we'll talk with you for the next 4 or 5 minutes. This is a custom here in Mid-Michigan where we chat before any one of our events, and we do it because we get together so seldomly face-to-face that it's a great way to keep the community informed and to keep the community going, and to just acknowledge old friends and find out how things are doing. It was a gorgeous day here today. I spent most of it sitting by the window working on my computer. I'm going to be in Oklahoma a week from this coming Saturday, and I was just polishing up my Oklahoma presentation, getting ready to send it to that very active chapter down there in Oklahoma. But I watched out the window, and it was bright and sunny and beautiful, and I think it was that way down around your home as well today, wasn't it, Mark?
Yeah, the weather's behaving pretty well, and we've been enjoying it. Although
no fires,
no fires,
no, nothing to disrupt the force right now. I feel so sorry for the folks in California right now. Our news gives the impression that there's fire wherever you go. I know that's not the case, but I do know that where it is burning, it's really horrendous. So our thoughts are with you folks that are out there California way, especially those of you that are in the Sacramento chapter. I know that some of those fires are getting awfully close to where you live. So if there's anything we can do, let us know. But short of that, we'll keep you in our thoughts and prayers.
Well, tonight I did something a little bit different, Ken. I left the recording on during the green room session. And I guess I would do that just to make a point that we usually open the doors 15, 20 minutes early for most of our sessions. And although we don't generally record it, just want everybody to know that we do that. We stick around before the program and stick around after the program.
I have a comment from our good friend Roy Chastain. He is in the Sacramento area, and Roy says that smoke in the air, even though the fires are quite a ways away from Sacramento, that there's smoke in the air, and they can smell them and deal with them. So we're glad you're safe, and we're glad the fires are far away, Roy.
Yeah, I have friends who live close to Salt Lake City, and the air's pretty thick there too.
I'm going to unmute Ying Hong Lee. Ying Han, you're unmuted. Do you have a question or a comment? Hello? Okay, that's an inadvertent hand, so I'm going to mute back up again.
A person.
Please make sure that when you press that raise hand icon that you want to say something. Okay, I have a hand raised by Teddy Lee. Teddy's or at least he has been a member of the BI Bright Club. And Teddy, we're getting a lot of feedback on your hand. I'm going to mute you again. A lot of feedback coming in. I'm going to try once more to unmute, Teddy. Hold on. Still an awful lot of feedback, Teddy, so I'm going to put your hand down. I have another hand from Tom Jones. Tom, go ahead. Tom, go ahead. And another inadvertent hand coming up there from Tom.
I believe
Teddy,
Tom's
your hand went back. Teddy, your hand went back up again, so I'm going to unmute. And now you're self-muted, Teddy, so you're muted on your side. If you want to speak, you're going to have to unmute from your side. And I'm taking your hand down. Your hand is down now, Teddy. Take a look at the icon. It's down right now, so that's the way. Well, it went right back up again. Okay.
It's like you're arm wrestling.
Yeah, I know. Teddy, I can't unmute you.
Something wrong. See, I'm not trying to be speaking. I'm trying
we can hear you now, Teddy. Go on. Do you have a question or a comment?
No, please mute me. I think something's
okay.
Don't
press your. I'm going to put your hand down now, so don't press that button again, okay?
Okay.
And Tom Jones, your hand is back up again, so I'm going to unmute you. Tom, do you have a question or a comment?
Can you hear me?
We can.
Okay, yes, I have a question. What do you think about Illumina at the current price?
Illumina, ILMN?
Yes.
We'll take a look at that tonight, Tom, and we'll try to get that question answered during the session, okay?
Great, thank you.
Okay, I'm taking your hand down and putting you back on mute. And Mark, we do have 8:30 by my watch, so we're ready to go, all right?
All right. And since I'm already recording, we'll just go ahead and launch. All right. Well, welcome everybody to Turnout Tuesday here on August 7th, 2018. This is our monthly, even less formal session. I'm joined here tonight by my friend Ken Kavula, hails from Michigan, and just a few miles north of me. And good evening, Ken.
Good evening, Mark. It's great to be with you again. This should prove to be an interesting session tonight.
I do. You know, Ken thinks I should apologize for the title. Certainly apologize to Burt Bacharach. But this subject really is what we're all about. We're about investing in better companies at better prices to achieve market-beating returns, which, as you're going to see, is what alpha really is. We measure how we do in everything that we do, all the demonstrations and stuff that we look at. And many of you know that this manifests itself in the roundtable sessions that we do monthly. We have now topped the threshold, beating the market by more than 5 percentage points over 8 years. We celebrated our birthday just a week ago tonight. So we're going to focus in on this alpha subject. And Ken, this really is for you. Be an alpha wolf. I know you're a card-carrying member as an alpha wolf up there. Is one of those 19 investment clubs that you're affiliated with.
Mark's referring to my original investment club called the Wolves. We wanted to be the Genesee County Investors. We went to the Secretary of State's office and found that name had been taken. So the guy that went was a member of our school community, and the school's mascot is the Wolves. So we became the Genesee Wolves.
There you go.
And we've been the Wolves ever since. I think we should make the point, Mark, that alpha is just Wall Street shorthand for the amount of money that you're making on an investment, right?
Exactly. We'll take a little bit deeper look at the definition, but seeking alpha, we think we more than seek alpha within this community. All of us gathered here, we expect it. we figure out how to target it like a laser beam, and we expect alpha. So that's one of the reasons that we have so much fun with that theme in general. Here's a little bit of legal housekeeping before we get started. Ken and I will be using real companies to talk about track records and using these methods tonight. So that is all for illustration and demonstration. The demonstrations that we do with the Mid-Michigan chapter in Manifest Investing have tended to be fairly powerful, and they're just a lot of fun, but they're intended to be educational. They're to demonstrate the philosophies and methods of the modern investment club movement. Anything else we want to add to that, Ken?
Oh, I think that that's a pretty good compilation of what we're trying to accomplish. Mid-Michigan is so happy that we've been able to put these programs together and then send them out to the entire country. It's really nice to attract an audience this size on a summer evening in the beginning of August when everybody's supposed to be on vacation. So sit back, don't be afraid to ask questions. We love to try to get involved in discussions. If you want to talk to us via your microphone, raise your hand. Your hand icon is down right now. So take a look at it. That's what it looks like when it's down. If you should click it, then I'll get a signal and we'll unmute you and speak with you through your mic. If you don't want to talk live, then type us a question. If you have a question or a concern or a comment, type it in the questions box and I'll monitor that as well during the evening. Mark, I think we're ready to get going. I just want to remind folks that if they'd like to be getting an email about these Turnout Tuesday dates, or for that matter, the roundtable dates, please send an email to my wife. That's N Kavula1, N for Natalie, nkavula1 at comcast.net. She'll put you on our mailing list. We promise that the only thing we'll do with your name is remind you when our roundtables and when our Turnout Tuesdays are coming up. This is not the Better Investing mailing list. This is the Mid-Michigan guest list that we're adding you to, and we'd be very happy to add you to the 800 or so names that we already have on the list.
Yeah, and we're so pleased that so many of you show up when you say you're coming, and it's an honor to serve you. So let's get into the subject. Let's talk about this again. Apologies to Burt Backrack, but what's it all about, this alpha? We're basically going to take a look at this notion of relative return. You'll hear us describe it. What is this alpha? How do we measure it? We're going to talk about, why do we focus on it? That type of stuff. Again, this dovetails into the better selling stuff that we've been talking about for the last couple of years. It's one of the things that we think merits or is worthy of more attention when it comes to this rule of five. We'll cover the rule of five here tonight and talk about it. But basically, I'm going to set the table with a little bit of what is it and why do we care. And then Ken is going to walk you through a hands-on demonstration. Go live to a couple places and show how to track the relative return of the alpha of any decision that's made by an individual investor or an investment club, so that we can use this concept of using the relative return on a specific investment to trigger the need for further analysis, possibly a selling audit/evaluation. Any other comments to that, Ken?
Well, nothing, except this is what we promised we were going to do at the last Turnout Tuesday. We would like to always focus these particular sessions on topics that you'd like discussed in detail. So don't be afraid to drop Mark or myself an email and suggest topics for further Turnout Tuesdays. We're happy to put together a program, and we especially like to put together programs that have wide audience interest. So if you have something you'd like us to discuss, something broad that you'd like us to move into or to bring to the forefront of the educational forum right here, drop us a note. I think our emails are in lots of different places, and I think you'll find them at the end of this presentation as well.
Okay, so let's get rolling. So what is this alpha? And it really is just a simple reference to a measurement. It's actually comparing the in the performance of an investment against a particular benchmark. And you'll hear us talk about relative return. We like positive relative returns because that means they are excess returns or beating the benchmark. And we like to beat the market individually and collectively. So again, the amount of return that is greater than if you had just invested in the benchmark itself. Now, the benchmark could be the S&P 500 index fund. It could be the Wilshire 5000 index fund. Ken is going to walk you through a couple different examples of that. But again, it's a measurement of performance. And as it says in that bottom paragraph there, courtesy of Investopedia. Again, if you want more on the subject, go to investopedia.com and just scroll through the stuff about alpha. I will warn you that much of the stuff at Investopedia is going to be consistent with things which we don't necessarily believe. And one of our core beliefs is that we do not believe that stock price volatility is risk, not real risk. Stock price volatility. So they're going to spend a lot of time talking to you about how you have to condition your returns based on the amount of risk involved. Well, that doesn't really apply to us. So again, if you go there, be prepared for that, to be barraged by that sort of thing. We look at the world completely differently from that respect. We like to talk about how well is our investment doing versus how well it would have done in that benchmark. If we'd invested just in the S&P 500 or the Wilshire 5000, you'll hear us talk about +3, -5, that sort of thing. It's just measuring the amount of overperformance or underperformance of a particular investment compared to a matching investment in the index. All right. I like to start with, you guys have seen this from us a bunch of different ways. This is alpha, and it really applies to this urgency of what we refer to as all of the above investing. And you're looking at a 20-year chart of two things. The black line at the top is the value line arithmetic average. That's basically taking an equally weighted investment in all 1,700 companies in the value line standard edition, the black book or the green book, depending, and tracking the performance of those 1,700 companies over time versus the blue line, which is just the S&P 500. And you can see a fairly staggering differential between the two going back over 20 years. The top line coming in at an annualized return of 11.5%. versus the S&P 500, which again is all those mega, very large companies. And this is just making the point that we all know, we cherish the fact that over the long term, if you can find excellent, solid, smaller companies that are growing faster, that are on sale, the names flow off of our tongue, the Neogens, the 26s, what are some of your favorites over the years, Ken?
I know you picked one of them. I'm one of my best performing stocks ever is Cognizant Technology because we discovered it so early. I also like Illumina. I like Google. These have been really great stocks in my portfolio. Currently, right now, my best performer is a stock called Align Technology. So there, you don't need a lot of those home runs to really spike a portfolio and keep it moving forward. And just like some of the batting greats in baseball, if they're hitting a lot of home runs, they're probably going to strike out a little bit more as well. So when you strike out 4 or 5 times, if you have a huge boomer home run, it kind of balances things out for you. And I'm going to show you tonight how you can really quickly get the exact same kind of graph that Mark is showing you right now. And you'll be surprised, you'll be amazed at how fast you can do it and how you can begin to plot relative return for the actual stocks that you own then.
Mm-hmm. So again, very important stuff. Ken and I will be beginning our best small companies safari or endeavor here over the next couple of months. And if this year's like any of the years previously, we're going to get a handful of stocks from you guys from all around the country. Say, hey, you need to look at this exciting small company. And by golly, it's one of the places where alpha lives and you can actually sink your teeth into it. So we encourage you to go there. One of our favorite sources is on this picture. Actually mining alpha. This is a tribute to the Brown Capital, specifically in this case, their small company fund, not small cap. They're not the same thing. Small company. And in this case, you can see that obviously there's a whole bunch of alpha there. Their return on the Brown Small Company Mutual Fund is about 13% for the last 20 years, going back. That's per year for 20 years. Again, topping the market by 6 or 7%. This is huge. It's definitely super investing. This fund was actually formed by Eddie Brown. He's the guy on the lower right. Some of you may remember the Lou Rukeyser show, Wall Street Week. He was one of the elves. He was one of the regular guests for Lou Rukeyser because of his wisdom when it came to investing in better companies at better prices. You're probably not shocked that he actually had exposure to investment clubs. I believe he belonged to an investment club as a beginning investor. And the guy on the lower left is Keith Lee. Keith Lee talks and thinks just like we do. And these guys just continue to deliver ideas. But again, the point is, you find these type of companies and latch onto a few of them can be very, very rewarding.
Yeah, Mark, if you've been investing for a long time, you've probably been listening to Mark and myself off and on over the years. This was a very dramatic graph back in 2011, 2012, when everybody was speaking of the lost decade in stocks. And the lost decade represented the fact that the S&P line basically had moved nowhere from 2000 up to 2010, 2011, maybe even into 2012. But when compared to the value line index, there was just this huge difference that different size companies were really going to give you a lot more alpha. And this is the first time I've looked at this graph in the last 6 or 7 years, and Mark, it's spectacular today. The difference that you're getting from small companies and from a mixture of small, medium, and large companies is just absolutely outstanding. It's one of the most basic lessons that better investing teaches us, and one of the most basic lessons that a lot of us maybe haven't absorbed fully yet, even today.
Yeah, I think we have to ratchet it up even another notch when it comes to our demonstrations and everything. All right, so let's switch gears. We've told you this really applies to some of the selling stuff we've talked about. We want to, again, further emphasize that the stuff we're talking about here tonight is still experimental, but it's not intended in any way whatsoever to be in conflict with the stuff we've known for the last 60 or 70 years, the core concepts of there's only a few reasons to sell a stock: to fund a personal or individual need, because the wheels are coming off, the fundamentals or quality are in decline. We talked about that last month at the Turnout Tuesday. And the most common reason that we do make a portfolio decision is because you can make the portfolio better, improve the return forecasts, improve the overall quality, and keep the sales growth, as we've just been talking. Being such a strong contributor to potential alpha, you got to keep enough small companies in the portfolio. So we're not talking about messing with any of these, but trying to find techniques and methods that bolster and support what we're trying to do. Our efforts into this area actually took us into this notion of, watching the performance of the stock after the decision is made and the selection is made that just does not behave right. And what you're looking at here is a concept put forth by Investors Business Daily's William O'Neill, where they actually have a rule, and this is a little bit more momentum based with IBD, but O'Neill's rule for the momentum stocks that they invest in and follows, if that stock goes down 7 or 8%, you sell with absolutely no exception. It's more of a bit of a trading concept. We like the concept. When Ken and I we're scratching our heads over this, we like the concept, but we're investing, not trading. So it seems like maybe that 8% might be a little bit too low. And again, what about this notion of, what if the stock market goes down 10%, your stock only goes down 8%? That's a little different situation to us as a long-term investor. We care about how that stock is doing in comparison or moving with or against the overall stock market. So we wanted to make that part of our consideration as we talk about this notion of tracking the price versus a benchmark as a potential selling trigger, or at least a selling analysis trigger. So the resultant concept we came up with was, let's keep it simple. Let's track the actual return. Ken's going to demonstrate it hands-on here in a few minutes. But we track it numerically. You can track it with pictures. But we're talking about initiating an audit and or a selling analysis, making sure all your information is current, you've got all comfortable with all the assumptions. But when the annualized relative return reaches minus 20, in other words, an alpha of minus 20 in the actual return category, that's when you want to call time out and figure out what's going on. So again, your investment would be lagging the market by 20 percentage points at that point in time, and you just want to take a deep breath, step back, and take a closer look. Anything you'd like to add to that, Ken?
No, not at all, Mark, except to say that one of our biggest questions from our audience has been, how do you actually calculate this return? It's not something on the SSG. It's not something that comes up immediately when you look at financial websites. So tonight I thought what we were going to do is to show you two different websites and show you how you can use them to very quickly come up with an alpha value for almost any stock that you own. Mark, if you can throw the screen to me, I'd appreciate it.
Okay, let me see if I can remember that. Change presenter. Kick it back to you.
Thank you. And I hope what you're looking at right now, folks, is a screen from my computer that is showing a website called Big Charts. I use this website quite a bit. I like it. BigCharts.com is enough to get you to the website. It's actually BigCharts.MarketWatch.com, but BigCharts.com will get you right to this website right here. And what I like is that I can do some reading right from some graphs, and I can show alpha. Let me use Align Technology, my best performing stock in my family club portfolio right now and in my personal portfolio. And here's how you do it. Here's the actual step-by-step in real-time way to calculate alpha for Align Technology. Now, I'm going to warn you ahead of time that you will need a little tiny bit of data. If you want to calculate alpha, you must know the date that you purchased the stock on. So I have the tickers and the dates written down in front of me, and from Big Charts, I'm just typing in the ticker. That's easy enough, and I'm hitting Advanced Chart. The first time through, I'm going to have to set my chart. So notice that I have the Align up here in the symbol box. I'm going to change it from a 1-year time span to a custom time span. And on the From box, I'm going to put in the date that I purchased Align Technology. I've owned it for a little bit more than 2 years right here. It was purchased on April 7th, 2016. The daily is okay. And then I'm going to expand this box right here, and I'm going to compare it, and I'm going to suggest two different comparisons. The one that I type in almost all the time is the Vanguard Total Stock Market Index. And you can see the letters just stand for what I just said. V for Vanguard, TSM, Total Stock Market, and then the X is a fairly universal symbol for index on these different indexes that we're looking for. And all I have to do now is tell it to draw the chart. And my computer does a little bit of thinking, and if you look carefully, you'll now see that besides the black line that represents Align Technology, there's a gold line that represents the total stock market during that same 2-year plus period. Notice that I can read where these two are sitting from the scale on the graph on the right-hand side. So I can see that the stock market has gone up, and I'm going to call that 49%. You know, if you call it 48, or if you call it 48.5, or if you even call it 47, that's going to be close enough for us to come up with this plus 20 idea that will cause a trigger for us to sell. I'm going to read the align number as 403%. And again, if you're reading it as 405 or 401 or 402, that's close enough. You don't need to do any other arithmetic except to take the 403 or the 405, which I read it at, and subtract from it the 49 of the stock market to get an alpha of 356% positive. It's above the market. It's beating the market. And I was able to do that calculation without looking up a single price in any particular website. All I needed was the date that I bought the stock. And what's so nice is I can now begin to move through my entire portfolio with changing virtually nothing. Let's say that the second stock in my portfolio is CVS because
something a little less formal here.
Okay, well, the second stock is CVS, and I purchased CVS on May 6th, 2010. Okay, that's all I have to do after I hit draw chart to come up with a brand new chart. And you can see on this chart that the that the total stock market index, that's the gold line again, is now beating the line for CVS. In fact, this one has a negative return. And again, all you need to do is estimate the numbers from the scale on the side. I'm going to estimate the Vanguard total stock market return to be at 152. And I'm going to estimate the CVS to be at about, I think I'll call that 78. And again, you don't have to hit it on the nose to get yourself a really nice idea of what's happening. For my investment, this has a negative relative return of 74%. I think you can also see from the graph where it probably would have been made sense based on the rule of 5. I can never find anything basically wrong with my study of CVS when I do an SSG, but I know that the rule of 5 tells me that 20% of the time when I do a tremendous SSG, I'm still going to be wrong. And, probably I'm holding CVS because I'm no longer being patient, but I've turned to being stubborn about it. It probably would have been a better sale when those two lines started to converge and the alpha was about 0, when the money was kind of dead. And there were a number of times when, it went back and forth between the orange line beating the black line and then the black line beating the orange line. Those would have been probably pretty decent times for me to unload this long-term holding. One more demonstration, and then I'm going to go to another website and show you. And this is a holding that I've had since March 2nd, 2014, and this is a stock called Illumina. A very interesting interview with the CEO of Illumina on the cable news network, the financial news network, CNBC. This is an extremely bright man talking about a company that is just on a tear as far as its business model is concerned. I don't think anybody anticipated this idea of testing your own DNA, finding out what your background was as far as your genes are concerned, and then putting that into a huge database looking for potential relatives. But this Ancestry.com, this 23andMe, these different commercial things are all using Illumina equipment right now, and Illumina does nothing more than it sequences the human genome, and it does it in a very efficient, very quick way. Here I'm pressing draw chart, And here's another one of those stocks that for a while had a negative return during my holding period. I buy small stocks a lot of times and kind of just push them away, put them in my back pocket and give them time to develop as a stock that I'd like to own as a long-term investment. And you can see that in the last year, maybe the last 6 months, that Illumina has begun to outpace the entire market. And again, I'm going to read the numbers from the scale. I'm thinking that Illumina is up around 95 and the market's up around maybe 50, which gives me a 45% relative return. I'll take that any day of the week for an investment that I've held for about 4 years. It's not exactly this doubling your money, but it's something that for a small company, especially if you have faith in it, that you can make a pretty nice killing on. I've been adding to Illumina on a regular basis since my first purchase, so some of my purchases were down in here, and I'm moving my cursor over when I'm saying down in here, and so what that means is that I have significantly higher return for those purchases. If I were to change the date for each lot, I would find that I would have a much higher relative return. But for the first time that I purchased it, I'll take 45%. Let me show you another free website where you can do the same kind of thing. And this time I'm going to go to, and if I can get there, now I'm going to StockCharts.com. I was just at BigCharts.com, and now I'm going to StockCharts.com. And right on the home page on StockCharts.com, don't register. You don't have to sign in for anything. You don't have to sign up for anything. What I'm going to use is free, and I'm just going to click this sharp chart button right here, and I'm going to ask for a sharp chart. And I forgot to type in the symbols. So let's put in the symbol GE, and then let's put in the symbol VTSMX. Again, the Vanguard Total Stock Market Index, and now let's press go. Separate the symbols with a comma, and what you get on one set of axes is what the total stock market has done. I bought GE back in 10/20/91, and notice that I haven't reflected that date yet on this chart. This is a 1-year graph. So this website takes a little bit more work, but not much. I've scrolled down to the bottom of the website, and I'm going to select my starting and ending date. I'm going to start when I purchased the stock, and I purchased it way back in, let's see if I can actually type that in there. I can.
Are you sure you want to do this? This is not going to be fun.
No, it's not going to be pretty, but I want to show people that I make the same kind of mistakes that everybody else makes. 1991, month was 10 and 20. This is one of the stocks that I originally purchased a long time ago. I actually inherited these from my father.
I think you probably need dashes there, Ken. Go ahead and try it.
Dashes?
Dashes instead of slashes.
Dashes. All right, let's try dashes. 10, 20.
There you go.
I inherited these from my father, so let's do an update. And again, it's not a pretty sight. It was a pretty sight up until 2007, 2008. GE is the black line. The total stock market is the blue line. So I had some nice alpha going on until 2007, 2008. In 2009, GE kind of began to mirror the market. It wasn't beating the market, but it wasn't losing to the market either. And that generally happened, kept going until somewhere around 2015, 16. And then you all know the story of GE today. Here's another one where I'm holding for all the wrong reasons. I'm emotionally attached to this stock. It's the last stock that I have that my father actually owned, and he worked there for 40 years, and so it sits in my portfolio with a big hope sign in the back of my head that one day it'll become the company it was. Probably that's not going to happen, but I do feel that it's probably reached a place where it's not going to lose any more money. Don't go out and buy GE, folks. I just don't think it's a very decent investment right now, but I'm demonstrating how to use the tool, and it's pretty easy to make work. Let's show the tool with one more stock. I've bragged on my wife for a lot of years about how she's been able to spot, and I don't want to, yes I do, VTSMX, how she's been able to spot trends. And we first bought Cognizant Research back in 1999 on September 2nd. And let's look at what Cognizant Research looks like today. And I'm going to hit update. And again, I have things going. You can barely see. You can barely see the S&P because the scale has gotten so huge. But you know, if you own a couple of stocks like this, then you can put them in your family accounts, you can put them in your personal accounts, you can put them in your IRA, and you can afford to send your grandkids and maybe even your great-grandkids to college and still feel like you've left enough money for you and your wife or you and your husband to live on. Look at the alpha in this stock.
Wow.
The total stock market, I can't even read this one off the scale. I'm going to say the total stock market is maybe 110, 120%, but the Cognizant return is up at around 15,500%. If you discovered this outsourcer early, when the word outsourcing wasn't even in our vocabulary, and then just bought it and stuck it away, you'd be in pretty decent shape today with that particular stock. I'm not going to do the other one that looks just like this, but the same graph, the same kind of graph you can come up with on Neogen. So, Mark, have you been looking at the questions box by any chance?
I have.
Have I generated any questions? Let's see right here.
Why don't you take a look at that? I'll just point out for any of you that wonder why Cy Lynch has nominated or selected Cognizant Technology so many times for the roundtable. I think this is pretty much self-explanatory over the last 8 years. It's almost as much fun as Apple.
Well, here's a question from George. George, I guess it's Mac or Mackie. Mm-hmm. George says, Facebook recently declined 20% in one day, although it is up for the past 12 months. Is it a sell under this criteria? And George, this selling trigger depends on what the return is during the period in which you have owned the stock. So if you bought the stock a month ago, the trigger might have been pulled by that 20% drop. I kind of doubt it because Facebook took a really big move up before it turned around and took a big move down. But it might have been pulled. Yeah. In the last 12 months, if you've owned it for exactly a year, and if it's up for the year, then you would want to know, is it up compared to the market or not? So let's assume, George, that you owned Facebook for the last year.
Just do the last year.
So I'm going to put Facebook in here. And down here, I'm going to put 1 year. And I'm going to update. And here we are with Facebook. That's the black line. And the total stock market. I can read these off the side pretty carefully. I'm going to say that the total stock market's about 17.5, and that Facebook is about 7. So it has a relative return of negative 10.5. The trigger that we're using is to go to negative 20. Well, I'm looking at the low point in August, and even the low point in August was down just below a 0 return for the year, and that spread between the black and the blue lines at that point was, if I'm reading it correctly, was only 16, 17 points. You know, there might have been a place back in April where Facebook actually had a 20-point spread. I'm looking at the low point in April, which I'll call it negative 12 for Facebook, and I'll call at maybe 7 for the total market. So even at that place where the spread appears to be greatest, I'm not looking at a 20-point drop. So no, in the last year, if you bought it a year ago, Facebook would not have sold out of the portfolio based on this trigger.
Yeah.
Now, we're not going to do this trigger on a daily basis. So there's a lot of places where the dots might be a little bit wider than that, but we'd probably measure the trigger, 12, 14, 15 times a year, Mark?
Yeah, and the point, one of the points to make, this is just one piece of the puzzle. At the bottom point in the middle of the chart there back in April, that's when Zuckerberg was testifying in Congress. And people had a lot of concerns about the business model. And that's precisely exactly what Roy Chastain and his club out in California, they sat down and said, maybe we should think about this. And in fact, I think some of the people in their club may have called timeout and sold their shares, as a precautionary moment. So again, the concept is to trigger a selling analysis. I don't think that the fundamentals of Facebook have been compromised enough to sell it outright based on that, even today, when they're basically talking about a slowing growth rate, top line growth rate, along with some increasing expenses to maintain compliance. It'll be interesting to see how this stock continues to shake out as it matures, and there are concerns even now about the compromising of the business model. So I think George's question is a good one. It's actually sitting at close to minus 20 based on this chart for the last year. So it is a worthy thing to debate and evaluate at this time.
Butch says, okay, well, I'm showing you how to do it for one purchase. How do you show performance for multiple purchases? Well, at that point, Butch, we get into an internal rate of return. We have to measure cash flows, and it becomes a little bit more complicated. But you can, by changing the dates, show your relative return for each lot that you've held, and then you can begin to compare those relative returns and see if any of them are hitting that 20% trigger. I'm not an accountant. Mark's not an accountant. We are fairly decent using spreadsheets, and I will tell you that if you want to do an internal rate of return and you want to watch cash flows and calculate various entry points with a number of different lots, it can be done. But you're going to need a few more skills than we're willing to demonstrate this evening, I think.
Yeah.
Is that a fair answer, Mark?
Yeah, if I get a chance, I'll show a glimpse of the spreadsheet showing how we keep track for the round table and for the Fave 5. So why don't we switch? Are you done with your...
Well, I want to do one more thing because we had a number of people point out, and I know it's there, but I didn't want to bring numbers into this very much at all. I wanted to show the folks in the audience that really are afraid of arithmetic. They're afraid of decimal places. They're afraid of doing anything, sometimes of even subtracting. I want to point out that if you're having trouble reading those numbers from the side scale, then you can go to the upper left-hand corner of this graph and you can look right next to the ticker and you'll see the return for the period of the graph spelled out to you in actual numbers. And if you want the relative return, it would be the 1781 minus the 6.88. I'm sorry, it'd be the other way around because Facebook's below. So it'd be the 6.88 minus the 1781 for a relative return of around negative 11%. So you can get the actual numbers for those of you engineers and chemists and you physical science people out there in the audience. But for you English majors and folks that are a little bit math phobic, learn to read your numbers right off the scale here. It's completely straightforward, very easy to do, and you can actually see the alpha just like Mark kind of pointed out on the chart itself. Okay, Mark, I'll turn it back to you.
All right, so do I need to switch us back to me? You can check the questions log while we're at that. And let's just keep trucking on with, again, reinforcing the stuff that Ken has been talking about, where the concept comes from. Again, you've heard me talk about this one. This is just an update on Iconix Brand. It's a selection that was made back in April 2015 for the roundtable. And during that session, you can actually go back and listen to it. We talked about this concept that if it dropped 20% faster than the market, we walked away from it, and we did do that. You can see that's the point on the left-hand side there. When it trailed the market by 20% just a few months after it had been selected, I swallowed my pride and said, this thing needs a timeout. We walked away with $800 of our $1,000. Now, the concept that we're talking about of this protective measure, if we had been stubborn and just held on to Iconix, because frankly, folks, that April 2015 is one of the best stock presentations ever done for the roundtable. It was perfect. There's, what could possibly go wrong with this story? So now, fast forward a couple years, this thing continues to sink every week, and it's now that $1,000 is now worth $20. So we basically avoided that loss, took our $800 and basically went shopping elsewhere with that $800. So again, it's kind of an anti-stubbornness potential. Again, we're just talking about using this type of a trigger to measure and monitor for the rule of 5. We'll take a look at the spreadsheet like Bush asked in a few minutes. But again, just this reality that every once in a while you're going to get a stock which just misbehaves very badly. In fact, CVS fits that bill for the last year or two. It's just been misbehaving pretty badly compared to the field of stocks all around. They've been generating decent operating results. The stock price is not reflecting that. So again, that is what's going on. So again, keep in mind, we're talking about not messing with the time-honored selling guidelines. We're still going to make the decisions on the portfolio based on the return forecast like we always have. In challenge mode, we are going to be watching for degradation, breakdowns in the trends for quality, but we're talking about using this relative return as an alert or trigger. And I just want to bring this all home with where this is, where we're actually demonstrating this and where it's working. Just to give you an example, here's the Fave 5 tracking portfolio results, again based on rate of return over approximately the last 3 years. If you're not familiar with the Fave 5, every Friday I try to find 5 stocks to share with the community, and then we track them in a tracking portfolio where we take and invest $100 into them. If it's selected for the first time, we don't do repeats. Repeats are just reinforcements. But if it's for the first time, we will put it at 100 and then track it. The type of selection mode that we do often is based on the triple play that we demonstrate often at the roundtables. Other times it's this notion of trying to buy a stock near its 52-week low. And that is named in tribute to Mr. McManus, Irish Spring. So what you're looking at here on the chart is the actual operating results using the rate of return calculation. It's a big spreadsheet for 3 components. Let's start with the one on the right. The green is the Wilshire 5000. Over the time for the tracking portfolio, again, the last 3 years or so, the market has returned approximately 15%. matching investments into the Wilshire 5000, the VTSMX that Ken's been talking about, have returned about 15%. The portfolio itself follows the sell discipline of selling if the return forecast gets too low, that challenge notion that we've talked about so often, making the portfolio better just by swapping out a low return stock for a high return stock, or if the selling trigger based on alpha, a minus 20 alpha is hit, that's the blue line in the middle. So what I did is I went back and said, what if? There have been approximately 50 of those type of transactions with a minus 20 alpha over the last 3 years. And I said, what if? What if it hadn't happened? What if we're able to Ebenezer Scrooge it and go back and say, what would have happened if we didn't sell them when we just got stubborn and held on to them, buy and forget? And what you're looking at there is the red bar on the left. If we had not made those relative return or alpha-based sell transactions, the portfolio would have come in at about 13%. So you're talking about a 5 percentage point gain in performance because of those times when we took companies like Iconix Brands and said, wow, it's dropped 20% faster than the market, time out. Send it to its corner, send it to its room, it's time for a timeout. And I think that's a pretty staggering result. Basically adding 5 percentage points, as Ken said earlier, we'll take that any day of the week. And it's turning out to be a fairly powerful thing.
Mark, we have a hand in the air from Herb Lemkool up in Traverse City. So, Herb, you're unmuted. Go ahead with your question.
Yeah, I'm just wondering, is when you calculate the big charts and everything else, does that include stock splits and dividends?
Yes, it does.
It's all figured in there, Herb.
Yeah,
so
whether you
all calculated part of it. Okay.
Yeah, and then on our spreadsheets too, we calculate the dividends. The prices are adjusted for dividends and for splits. So you're always talking a total return situation. Good stuff. So again, we've looked at like 50 or so of these minus 20 alpha triggers over the years. We've only seen a couple examples in 3 years of where it reversed and basically rewarded stubbornness. One of them was Ensign Group. You can see that you can actually on this type of chart, you can see that a 20% alpha would be 4 of these boxes. So if this black line is 4 boxes below the blue line, that was the point where we sold it, somewhere in this time frame. And that turned out to be a really good decision, but actually reversed here over the last year. This one is mortgage related and probably recovered. So out of those 50 transactions, the only other exception to that is Granger. GWW, the ticker symbol. I love the company, just absolutely love the company. The wholesale gadget company. So 2 out of 50. The other 48 have all basically seen deepening losses. They've gotten worse, and that's what accounts for this picture that you see here. That's what's driving that down. So we avoided, in 48 out of those 50 cases, a negative result for the overall portfolio. So again, we're talking about, how do we do this? How do we deploy it month to month? That's one of the reasons that we will continue to bring any stock in the roundtable portfolio, which has dropped to 20% behind the market. And right now, CVS is one of them. GE is the other. We only have a couple. We actually only have one company that fits that description in the Fave 5 tracking portfolio, and that's CVS. It's actually hovering at about minus 20 annualized since we picked it, and we're being a little bit stubborn with that one. So again, that's the type of stuff that we're looking at, and we think it just has very compelling potential.
I think it's important, Mark, for us to make the point also that this is a trigger for us to take a look at the stock. We've said from the very beginning that we didn't believe in automatic triggers for anything, and that there could always be good reasons why you should maintain ownership in a stock even though it had exceeded that particular trigger. Now, we're becoming convinced, I guess is a good word. We're becoming convinced of the fact that this trigger has more to say for it than we ever realized. In the beginning, we were kind of playing with what should the number be. Should it be 20? Should it be 15? Should it be 25? Should it be 30? And we just kind of picked 20 out of at random out of thin air, and we've been testing it right now. I think that some of our folks that are asking questions right now are not understanding that we're not looking to compare those graphs on any other time period except for where the graph begins. Piero says that there was a time on the Illumina graph that I showed where the difference was negative 25 or negative 30%. Why was I buying more at that point? And I'll explain. Number one, I still do not manage entirely by using this trigger. I still feel that this is a work in progress and an experiment. But number two, that second purchase of a stock at the point you talked about would have a completely different alpha than the alpha on the first purchase. And sometimes when I'm making a purchase like that in a small stock, I'm looking to bring myself back to a place where the entire holding has an alpha that's close to beating the market by 5 or 6 points. I do a lot of investing with small stocks. I do a lot of non-traditional investing. And so I'm not telling you that every single time this trigger is hit is a time that we should sell. I think we've hit the trigger with CVS 3 or 4 times in the last 6 or 7 months at the round table, and have each time decided to hold on to that stock. I think probably because we couldn't bring ourselves to believe that it was really as bad as it was. Not bad. As really as weak as it was. Bad's a bad word, but as really as weak as it was. Go on, Mark.
Yeah, and I think what I would do is notice, here's that moment back towards the end of 2016 for Illumina, and back towards the end of 2016, you had a very strong quality situation with the company and still pretty decent returns. So you have to look at this stuff all in tandem. I guess what I'm saying is I think the speed with which you hit that trigger and sell a stock is a direct function of the quality of the company and what your hopeful expectations are. And
I absolutely 100% agree with that, Mark. I'm much willing to hold on to a high quality company, quality in the 80s or even 90s, than I am to hold on to a company in the 40s or 50s.
Right.
We have a point from Mark Johnson, and he says, have you thought much about exploring whether 20% is the optimum value for this rule? And Mark, that's exactly what we're in the process of trying to determine. Is 20 a good number? Is 20 too high? Is 20 too low? And so far, we've been relatively happy with this 20% idea, especially when Mark can tell you that only 2 picks out of the Fave 5 portfolio are not behaving the way that we thought they were going to behave as you look at them today versus when the trigger was pulled. So yes, we are in fact looking at the number and trying to gauge whether 20 is a good number. Laurie wants to know, do you always use VTSMX as the comparison? Laurie, there's an ETF that measures the total stock market. It's called VTI. It's almost identical to VTSMX, so you could use VTI if you wish to use that. I know a lot of people use the S&P 500 index as their benchmark for alpha. There are even people out there, although I wouldn't recommend it, that use the Dow Jones Industrial Index as their measurement for alpha. I think that's much too narrow an index to use, but I know people do it. So the choice of index is up to you. Mark and I just would suggest you use as broad an index as you possibly can. Joan Clark wants to know, how do you get the annualized return, not just the total return? Joan, I'm speaking in Oklahoma in a little bit less than 2 weeks, and I put a slide in my presentation because I'm going to be talking about this very topic for part of the day. I put a slide in there for the folks that really want to know how to do the math. I would suggest you do a Google search of how do you calculate annualized return when you know total return. If your mathematics skills are fairly decent, if your calculator skills are pretty good, and if your spreadsheet skills are pretty good, it becomes a fairly simple task. But for me to explain it to a general audience would have brains exploding all over the place, and I'm not prepared to be responsible for that. So I would suggest that you go and do a search. Look for how do you calculate annualized return when you know total return, and you'll come up with a formula that is complicated but not especially difficult. Mark, anything to add to that?
Yeah, what I've got on the screen, and this is responsive to Butch's question also, and the question that's being asked is you can put together a spreadsheet, which is pretty straightforward. I can give you a copy of this that you can fill in your own squares. You can see what you're looking at here is the relative return on stocks that are in the Fave 5 tracking portfolio. And notice, as I told you, CVS is the only one that we're emotionally attached to and stubborn with. That's at a minus 22, so it's on the alpha hot seat. But just notice some of these returns from top to bottom on these selections coming out of the Fave 5. They're not all green, but most of them are. And some of the results are just phenomenal. A couple 20s that we'll be taking a little bit closer look at this week. McKesson, which has come up in discussions, and Middleby of all things. Middleby is an example of a company where probably give it a little bit of latitude, as it's a pretty good company. So again, this spreadsheet is what we use to track the individual lots that were questioned earlier. We do this for the roundtable. If you go back and look at the roundtable PowerPoint or listen in, you can actually see on the displays we used the multiple selections by Cy Lynch for Cognizant. Each one treated independently so that we have a relative return on each individual decision. And keep in mind, you're talking about 14, now 15 decision points with Cognizant technology over the years.
So, yeah, the only thing I would say, Mark, about this annualized total return column is please make sure that you're looking at enough time for that calculation to make some sense. If you're trying to calculate annualized total return for a stock you've owned for only a month or two, the numbers will swing wildly. So please make sure that you have enough annual in your annualized total return for the number to begin to make sense.
It's a great point, everybody. If you're looking at the sheet, anytime a stock has less than 1 year for the holding period, we use 1. So we're actually looking at the absolute. It's not annualized in any way. We begin annualizing after a stock is more than a year old. So you'll see that in the sheet, in the example that I put out.
Mark, Jane Johnson is just driving home the point that we've made a couple times this evening. She says, would it be a good thing to look at the reason for the stock's decline and whether the problem is permanent or short-term? And that's exactly what we mean by this being a trigger, Jane. It's a trigger that forces us to take a look at the stock and try to decide what's happening and whether we think it's something they're going to recover from in the short term. If we would have looked at Facebook during April when Zuckerberg was testifying before the House and the Senate, I think we would have said to ourselves that if you listen to the testimony, you would understand that our elected leaders didn't quite get what Facebook was trying to accomplish or even what Facebook does to monetize itself. And we were pretty sure that it was a fairly temporary situation, that negative alpha going on. the earnings report that was recent for Facebook's a whole different story. But yes, we would try to look at the problem and try to decide if it's permanent or short term. We've done that with every single stock that we've submitted to this particular trigger. Mark, Nick wants to know, can you look at Iconix and see the declining quality along with the decline in value? Did that happen?
I'd rather not.
All right.
But I'll do it just for him. I'm not even sure we even still watch it. Oh, we do.
You almost got out of it there, and there's that declining quality. Pretty dramatic declining quality.
Yeah. Again, that's another prong of the three-prong stuff that we're talking about. If the quality trend is deteriorating, that alone can be enough to walk away from a stock.
Well, that gives us a good transition, Mark, into talking a little bit about quality. But, we're already at an hour and 5 minutes, so maybe we can save this particular part of our presentation for our next Turnout Tuesday. What do you think?
Absolutely, and maybe people can bring other questions. We can put out a version of the spreadsheet that people can tinker with and see if they have any questions. But again, what we keep coming back to is this notion of we're not talking about changing any of the time-honored principles. We're talking about engaging current technology and the resources at our disposal to do things like watch a quality degradation as it begins to unfold and find protective measures, to notice when a stock for inexplicable reasons is failing to keep up with the stock market. And of course the time-honored one of manage to the whole portfolio, use portfolio-centered decisions to make the portfolio better. Those three things in combination are probably the most powerful selling disciplines that we could possibly imagine. And we look forward to continuing to refine, to pursuing Mark Johnson's question of, is the number minus 20? I think minus 20, even if it's accidental, probably ended up in a pretty good spot because of the number of times that it has failed to protect us. There's only 3 out of literally hundreds, if not thousands, of case studies. So we're pretty enthusiastic about what we're seeing happen here and the types of things that can really help with the challenging notion of selling stocks from portfolios.
Okay, now, Mark, we're getting a lot of folks that are thanking you in advance for sharing the spreadsheet. I think you should make it clear what spreadsheet you're sharing and what it's going to show.
Well, I'll basically take a model portfolio that will show the spreadsheet. You'll have to enter in exactly the stuff that Ken was showing you with the charts. You got to know the purchase date, and you're going to have to enter in the purchase cost. We'll give examples, obviously, but it's embedded in Solomon, so I'll have to do some extracting. But it's the type of thing where you can take a look at individual lots over time, and most of it will be self-explanatory, but we'll provide some users tutorial stuff with it also.
Tremendous. And again, the spreadsheet is going to be a tool for you to use to make your portfolios better, to improve your performance. We're not going to guarantee that anything that we're talking about as an experiment right now is something that should be followed 100% of the time or even 80 or 50% of the time. We're talking about experiments that we're doing and ideas that we're having right now to help us improve selling even more than the time-honored traditions that we firmly believe in. About making the portfolio better, about fundamentals and decay, and about when you need the money. Those are the times you sell. We have only one question left in the question box, Mark, and Tom Jones is asking, he says the par for manifest on Illumina right now is 2.2. Should we still hold it? I want to hear what your answer is, and then I'll give him my answer. Okay, Mark?
Well, I like the company. It's been one of our in fact, I'm pretty sure it came to us from our best small companies. I'm emotionally attached to it, but at the same time, I think it gets a long leash. So I would want to put any consideration on Illumina into the broadest context possible. Let's take a look at what Tom is looking at, and yeah, the par is down around 2%. Not the end of the world. It's down at 2% because the stock price has soared, putting smiles on many of our faces. So I would treat it as core. I would definitely, I don't know what happened there. I would hang on to this unless the projected annual return went negative, and just kind of hang in there on it. And as long as that quality continues to behave, perhaps even strengthens, I wouldn't be the least bit surprised to see future analyst reports actually have bolstered fundamentals also. So all those things add up to, I would watch it closely. I would not sell it unless it went into negative territory on the projected return.
Tom, my answer has a lot of overlap with Mark's, as you might anticipate. I don't consider Illumina a core holding, however. I consider Illumina in a group of stocks that I classify as small, potential, life-changing, or world-changing kinds of stocks. When Illumina was first brought to my attention that they were reducing the time to sequence the human genome, and at that point, the argument was about coming up with designer drugs for oncology and for heart disease that matched the particular genes of the person that the drug was going to be used by. I thought it had unlimited possibilities. The possibilities of these commercial sites just testing your genes because you want to know where your genes came from never even entered my mind. But I put Illumina in my small company portfolio. I give it a longer leash, and I agree with Mark that I would not sell it unless par moved negative. I would never sell a stock. And Mark, if you can go back to the Chronicle real quickly for Illumina and look just above the Chronicle, Mark. This is Tom Jones now. Tom, look just above the Chronicle and you'll see the cycle that Illumina is on for data updating. I would never sell any stock based on return when it's almost ready to get an update in the Manifest universe. Manifest updates its stocks on a quarterly basis, so you can take the fundamental data date, add 3 months to it, and that's the approximate time when we're going to have an update. So we're due for an update in the middle of August sometime, and at that point, I'd want to carefully take a look at what the return is. If it's gone less than money market or gone negative, then I might consider selling it. Might is the operative word because it's sitting in a part of my portfolio that I've classified as non-traditional investments. Basically that's under the non-core heading, and I'll do different things with those non-core stocks that I wouldn't do with the 85% of my portfolio that is core holdings.
Yeah, and one last reinforcement, George Nicholson in the Investor's Manual points out that when you've got a company, especially an exciting, promising company that's growing at greater than double digits on the top line, and sales growth forecast is somewhere in the 16% range for Illumina, he just said, in his own way, he just said, be slow to sell that type of stock. So we would continue to have that outlook. Now, I will, and we're running a little bit long, but I will point out that we had this discussion on OLED a few months ago, and we did not pull the trigger. And the stock price went from 200 to 100. It actually went into the 90s. So there are times when you can have an exciting, promising company, the type of company that's in that special part of Ken's portfolio, and those speed bumps can be kind of nasty. And you can see the speed bump right here for Universal Display. So we said all these same things about Universal Display back when its projected return was approaching zero and the stock price was in the 200s. So it's kind of to each his own, but by the same token, I think we're going to be all right over the long term. We've had universal display in most of our portfolios for years.
And I guess what's ironic, Mark, is that the current par for universal display would be something that we would consider to be really great if the price hadn't moved up to where it had moved and then moved back down again. We've had good alpha on this company. It's just not great alpha anymore, but we've had real good alpha since we purchased this stock.
Yep. And I would give this one a lot of room to run. In fact, I just bought some. Full disclosure, I've bought universal display within the last few weeks.
Yeah. Mark, I've got our question box. Oops, I just get a new one here. Just when I thought I was finished. Hold on a second. Nick would want to know, would my answer on aluminum be the same if the entire portfolio's par was around 8%? Nick, I have very rarely seen my portfolio's par move below double digits because I focus so much on making sure that I have a lot of small, faster growing companies in the portfolio. And if my portfolio is, if my par is only beating the market by 2 or 3 points, then my Illumina answer would probably be the same. I think the only time that I would maybe consider selling some of these ones with low pars is if the par in my entire portfolio dropped below the market average. And I just, gosh, I haven't seen that happen for any of my portfolios in a long, long time since I began looking specifically to keep the number of small companies robust in all the portfolios that I manage. So there's my answer for Nick right here. And we do have the other questions answered, Mark, so I don't see any hands in the air. I have the question box cleared. So again, thank you so much for being here this evening, Mark. This was a wonderful conversation. I hope that we are able to have the same conversation again. Natalie will be sending out a notice as to when our next Turnout Tuesday will be. We haven't set the date as yet. Mark, did you put a coming event slide on this presentation or not?
I didn't, but I could find one if you really wanted it. But
no, I don't think we need it. But we invite everybody to come to the roundtable, which will be the last Tuesday of this month. The roundtable will be on August 28th this August. So join us for the roundtable. It's a slightly different format, a slightly different direction where we're actually picking stocks that we like. And until then, good night, Mark, and good night, everybody else.
All right. Thanks, Ken.
Thank you, Mark. Good night.